Stockholders' equity. We're getting near the end. The first item in the stockholders' equity section is stock. Common stock is the most common type of stock that's out there. If you just call your broker and say, buy me some Facebook stock, you're going to get common stock. Common stock has a par value on it that is usually a very little number, and it's used for legal purposes, but it's also the amount we use when we make an entry to the common stock account. So common stock is held at par, but hopefully we sell it for way more than the par value, so that additional amount we get is called additional paid-in capital in excess of par, or some combination of those words depending on the textbook that you use. The second kind of stock that we can issue is called preferred stock, and those usually have some special features to them, but the one feature that's common to all preferred stock is that you have to pay the preferred shareholders before you pay the common shareholders. So they have preference over the dividends, thus the word preferred stock. Preferred stock also has a par value, and that again is the amount that goes into the account, but it has a little bit more important meaning for preferred shareholders because usually the dividends are stated as a percentage of par. So if I have a preferred share that has a par value of $100 and it says the dividends are 5%, I'll get $5 in dividends anytime the board decides to declare a dividend. Doesn't mean they have to pay you the $5 every year, but before they ever pay a common shareholder, they have to give you your $5. The last thing about common stock to the company is the company makes a journal entry when they issue the stock. So last year Snapchat had their initial public offering. They went public. They issued shares at $17 a share. And so at that point, they'll make that journal entry to increase this common stock and the additional paid-in capital. After it's out in the market, the company doesn't make journal entries when the stock price goes up or down. Those are transactions between individuals, not between the company itself. So while they care about the stock price going up, Snapchat would not make any journal entries if the stock price trades for 20 or if it trades for 12. That's not their problem. All they know is they got $17 a share when they initially issued those shares. Another thing a company can do is buy back their stock off the stock market, and we call that treasury stock. So a company, if I'm Facebook, I can go out and buy Facebook stock and get it out of the market. And the reason I might want to do that is to increase the stock price a little bit. If you have fewer owners, if you have fewer shares out there, the stock price should go up. The treasury stock then is the difference between the stock that's issued and the stock that's outstanding. So if I issued 1 million shares and I buy back 100,000 shares, the outstanding shares are now 900,000. The nice thing about treasury stock is I can always start selling it again, and if I do that, that should reduce my stock price. So it's a way that I can manage my stock price through the use of treasury stock. So let's see what the journal entries would be. I think those definitions make a little bit more sense. So let's say I issue 10,000 shares of common stock with $1 par for $17 per share. The cash I'm going to get is $170,000. My common stock is credited at par, so that's $10,000. And the paid-in capital is the difference, so that's $160,000. If I then retire some shares, then let's say that's at $25 a share. The common stock has to go down by $3,000. My paid-in capital will go down by $72,000, and the cash that I pay is the $75,000. If you retire shares, then you can't issue them again They just get canceled out. Rather than retiring, I could buy back some shares and hold them as treasury stock. And the advantage here is I can always sell those if I decide to, whereas once you retire it, you can't resell those. So let's say I buy back 2,000 shares for $28, so it's going to cost me 28 times 2, that's $56,000. Just put all that in treasury stock. That's the cost of the treasury stock. Notice treasury stock has a debit balance because it reduces the amount of stock that is outstanding. And then if I decide to sell some of those, let's say I sell those 1,000 shares of treasury stock for $35, I'm going to get $35,000 in cash. Treasury stock goes away at the $28, what I paid for it. And so I've got paid in capital of $7. The important thing is you can't recognize gains and losses on the sale of your own stock. Otherwise, think of how companies could really manipulate their net income by buying and selling their own stock. You want them to do something, not just manipulate the market with their shares. So gains and losses on treasury stock go to paid in capital. Again, they don't go on the income statement. Normally, the last item on the balance sheet is retained earnings. This is your final home for net income over the life of the company, less your dividends. If you remember, you closed those to retained earnings. So what's left in here are all the earnings of your company over its lifetime that you haven't paid out in dividends, so they're still retained. So retained earnings is not a particularly clever title. It's the earnings that are still left in your company. We've already alluded to this, but the order of payments, first, the company has to pay the debt holders because that's a legally binding obligation. If they want, they can use some excess cash to then declare dividends for the preferred shareholders. Once the preferred shareholders are paid, then they can pay dividends to the common shareholders. But again, dividends are only booked when they're declared. The common shareholders, if it's because of dividends or because of bankruptcy, they always just get the leftovers. The nicer way to say that is they have the residual interest. So one final reminder, no such thing as dividend expense. Don't let anybody ever trick you. Dividends don't go on the income statement. Only reduce retained earnings because that's pulling money out of the company and giving it back to the owners.